Good day, ladies and gentlemen, and a very good welcome to my YouTube channel. As you can see by the title on the screen, today we are covering IAS 16, which deals with property, plant, and equipment. Let's get straight into it. After you have studied this learning unit, you should be able to do the following. Number one, identify the scope and purpose of IAS 16. Identify the recognition of the original and subsequent cost in respect of property, plant, and equipment. Identify the measurement of property, plant, and equipment when recognized, including the measurement of cost components. Lastly, be comfortable with the measurement of PPE subsequent to initial recognition. So this is subsequent measurement. Now, what exactly is property, plant, and equipment? Property, plant, and equipment consists of tangible assets, sometimes referred to as fixed assets, which are held for use in the production of goods or for the supply of services or for rental to others. Lastly, for administrative purposes and are expected to be used for more than one financial period. The intention is clearly to use these assets to generate revenue rather than to sell them. If this definition is met, then the next step is to check if the recognition criteria are also met. There are two recognition criteria in IAS 16. Let's take a look at initial recognition and measurement. We recognize property, plant, and equipment when it is probable that future economic benefits associated with the asset will flow to the entity and when the cost of the asset can be reliably measured. In terms of measurement, PPE is initially recorded at cost. Subsequent costs are only recognized if the costs can be reliably measured, and these will lead to additional economic benefits flowing to the entity. In terms of IAS 16, the cost of property, plant, and equipment will be comprised of the following. Number one, the purchase price plus import duties and taxes. Number two, any other costs that are directly attributable to bringing the asset to the location and condition necessary for it to be capable of operating in a manner intended by management. For example, this will include installation costs, delivery costs, and etc. And lastly, the cost will also include the initial estimate of costs of dismantling and removing the item and restoring the site on which it is located. Let's take a look at subsequent measurement. IAS 16 allows two alternative accounting treatments for PPE without indicating any preference. After initial recognition of an item of PPE at cost, the asset may either be shown at the cost model or revaluation model. The cost model is basically the cost less accumulated depreciation and accumulated impairment losses. The revaluation model is a revalued amount being the fair value of the asset on the date of revaluation, less accumulated depreciation and accumulated impairment losses. An entity adopts one of the models as its accounting policy and applies the policy to a specific class of PPE. Depreciation measurement. The measurement of depreciation involves estimating three variables: the residual value, which is used to calculate the depreciable amount, the useful life, and the method of depreciation. The depreciable amount is the cost of the asset or other amount, for example, fair value, less residual value. The residual value is the estimated amount that an entity would currently obtain from the disposal of the asset at the end of its useful life. In terms of depreciation methods, there are three types of depreciation methods. Number one, the straight line method, the diminishing balance method, and the units of production method, also called the sum of the units method. Let's dive into the three methods of depreciation. Number one, the straight line method. The straight line method is a simple calculation involving dividing the depreciable amount dividing the depreciable amount over the useful life of the assets. It is important to remember to deduct the residual value from the cost. The diminishing balance method is a method of depreciation where the amount allocated declines on an annual basis, is used where there is uncertainty about the amount of income that will be derived from the asset. The last method of depreciation is the units of production method. The units of production method results in a charge based on the expected use or output of the asset, called production units. It has the added advantage that it will prevent the depreciation of assets before they have been brought into use, as the depreciation charge will only arise when the asset is used to produce units. So with the units of production method, you basically look at the capacity of the asset and the output that the asset has produced in a particular financial reporting period. Let's take a look at component accounting. We have significant parts or components which are required to be depreciated over their estimated useful life. We also have costs of replacing components which are required to be capitalized. Continued operation of an item of PPE may also require regular major inspections for faults, regardless of whether the parts of the item are replaced. When each major inspection is performed, its cost is recognized in the carrying amount of the item of PPE as a replacement if the recognition criteria are satisfied. Spare parts, standby, or service equipment. These are classified as PPE when they meet the definition of property, plant, and equipment in terms of IAS 16. And when this definition is not met, these will be classified as inventory because they would be held for sale. In terms of disposal of an asset or derecognition of an asset of PPE, we remove the asset from the statement of financial position on disposal or when withdrawn from use and no future economic benefits are expected from this disposal. The gains or losses from the disposal are the difference between the proceeds and the carrying amount and are recognized in the statement of profit and loss. When a revalued asset has been disposed of, any revaluation surplus may be transferred directly to retained earnings. Let's take a look at a typical example. Company ABC is a company that manufactures electric motor vehicles. Company ABC has a February financial year end. You are the financial accountant responsible for the finalization of the financial statements for the year ended 29 Feb 2023, and you obtain the following information. Before we get into the information, let's take a look at the required. You are required to prepare the journal entries to correctly account for the collaborative robots, machinery in the financial statements of Company ABC for the year ended 28 Feb 2023. The journal entry regarding the related deferred tax effect is required. Journal narrations are not required. Company ABC makes use of collaborative robots, also referred to as cobots, to manufacture its electronic motor vehicles. On the 1st of March 2016, the cobots were acquired for 16 million rands in total. The cobots were immediately available for use as intended by management. On the 1st of March 2016, the useful life and residual value of the cobots were estimated at 15 years and 1 million rands respectively. There were no changes to the useful life and residual value of the cobots since acquisition date. On the 1st of March 2019, the Central Processing Unit, CPUs, which are significant components of the cobots, had to be replaced at a cost of 3 million rands. The CPUs were not identified as separate components at initial recognition, and it has now come to light that these components need to be replaced every 5 years. The residual values of these CPUs are insignificant. It is the accounting policy of Company ABC to subsequently measure machinery according to the cost model in terms of IAS 16. Machinery is depreciated over its useful life according to the straight line method. Back to our required. You are required to prepare the journal entries to correctly account for the collaborative robots machinery in the financial statements of Company ABC for the year ended 28 Feb 2023. Now let me know in the comment sections what your debit entries will be, what your credit entries will be. And as far as deferred tax is concerned, suppose the company uses Section 12C in terms of the Income Tax Act. Suppose Section 12C says the capital allowance that can be claimed is 40% in year one and 20% over a period of 3 years. So what would your journal entry look like as far as deferred tax is concerned? Let me know what your journal entries would look like. I will share the answers in the comment section. And in terms of the questions that you can expect from this topic, you can expect journal entries, you can expect theory questions, you can expect integrated questions where you have IAS 16 integrated with IAS 12, which is deferred tax. You can also have IAS 16 integrated with IAS 40, which deals with investment property, and IAS 38, which deals with intangible assets, as well as IAS 36, which deals with impairments, and IAS 8, which deals with changes in estimates and correction of errors and etc. For example, you can get a question where there's been a change in the residual value of an asset, and that's where IAS 8 would come in. So be aware of the different types of integrated questions that you can expect. Be comfortable with the theory questions, be comfortable with the journal entries, and lastly, disclosure. Be comfortable with your disclosures. As far as IAS 16 is concerned, you need to be comfortable with the PPE note. Otherwise, thank you guys so much for watching. Please don't forget to like, comment, and subscribe. Goodbye.